Perfect. Ladies and gentlemen, welcome to this panel discussion this early afternoon on Thursday with the topic factor-based investment strategies. I'm very pleased to welcome so many of you and also to welcome our panelists on this panel board for the next 40 minutes. Two administrative topics before we start. One is, if you do have any questions, please at any time raise your hand. But wait for us to hand you the microphone because everything will be recorded. So if you do ask something without having a microphone on the record, we can't hear your question. So that just maybe needs you to stop before actually pose your question until you have the microphone with you. And secondly, Christian has to leave rather on time. So we try to have a hard stop at 22:03 in case you should have any question directly to Christian Lehr. Try to ask him beforehand or maybe write him an email afterwards, just those two administrative topics. Factor-based investment strategies will be the topic for the next 40 minutes, and we're trying to give a broad global overview what exactly is factor-based investment, what strategies have been proven to be successful, what aspects might not have been as successful in the last couple of years, and then obviously have some professional insights with specific strategies that these three gentlemen here work with on a daily basis. Quickly as an introduction, I present to you the panelists on the very right from your point of view, Christian Lehr. Christian is a senior investment specialist and deputy head of investment products, multi-assets with Nordea Asset Management. Before joining Nordea Asset Management in 2018, he worked as a senior product manager for Nordea Private Banking Luxembourg, and prior to that, held the role of a senior product manager at UBS Wealth Management in Frankfurt and Luxembourg. Christian holds an MBA from Kansas State University, and prior to that, earned his university diploma from Justus Liebig University in Germany. Welcome, Christian.
Thank you.
Second panelist would be Dr. Martin Schlatter from Swiss Rock. Martin started his career 25 years ago at Credit Suisse, building risk management software, which in his own words sounds funny in retrospect, so I actually quote him here. With a newly formed quant team at Bank Lehr, he launched his first factor fund in 2000, survived the internet bubble crash, the global finance crisis, and COVID. So the strategies have proven robust. Today, he is responsible for European, US, and global equity factor strategies at Swiss Rock Asset Management. Martin, welcome. And last but not least, to my left is James Murray. He is an investment manager for systematic equities. James works with Jupiter. Before he joined Jupiter in July 2020, he worked at Merion Global Investors since 2018. He was previously a director in the quantitative research group at Citigroup and was previously held quantitative research positions at Macquarie Securities and Man Group. James has an undergraduate degree in economics and 3 master's degrees in finance, statistics, and artificial intelligence. And as he told me before, he actually passed his CFA in this very room 20-something years ago. So welcome to you, James.
Thank you very much. Thank you.
I take the opportunity to directly start with you, James, to maybe give us a broad overview. What exactly is factor-based investment? How will you describe it? How would you define it from your personal point of view and experience?
Yeah, great high level setting the scene, I guess. So factors, taking a step back, we can essentially split risk into 2 dimensions. We can look at company-specific risk and we can look at systemic risk and factor risk. So factors can be anything that drives a broad cross-section of stocks. That could be sensitivity to interest rates, that could be sensitivity to market exposure, or beta as we know it. In contrast to things like, for example, Tesla yesterday announced that they were going to start making cheaper cars. That is a bit of information which is company-specific, diversifiable risk as we know it. We really focus on factors, things that affect a large cross-section of securities, things that explain how one security might move relative to another, and we use that to forecast stock returns.
Thank you. Christian, you mentioned in the preparation that you have some particular views or particular strategy when it comes to the premium of risks, factor premium. Maybe you can chime in a little bit as well here with regard to how exactly that comes into the whole factor-based investment strategies that you're offering?
Sure. So basically our team, the multi-assets team, is doing all the allocations in the different strategies based on risk premia. And risk premia is basically like the premium return you get for, accepting a certain level of risk beyond the risk-free asset. And I think the very interesting point about factor investing or risk premia investing is actually that you can build different products around this topic, different products around, risk premia or factor investing. So on our side, for example, in general, we're talking about multi-assets, and the type of products that we are, kind of like managing based on this risk premia approach varies from, more kind of like multi-asset products where we are not investing like top-down based on asset classes, but bottom-up based on risk premia. We do have kind of like enhanced indexing products where kind of like a smart beta approach, if you will, but where we do not select the benchmark constituents for our portfolio based on this traditional market cap approach that you often see, for example, like in passive ETFs, but we are also using risk premia in order to, kind of like extract these benchmark constituents for our portfolio where we believe there is an added value. And then last but not least, with this risk premia approach, we are also able to kind of like offer liquid alternative investment products. So where we have like a bunch of, let's say around 20 to 30 different risk premia that we are using within that product. These can be equity long-short strategies. This can be carry-based strategies. This can be value and momentum strategies on the fixed income side, where we are really combining a whole set of risk premia in order to get a very multifaceted portfolio with regards to liquid alternatives. So I think this whole topic, factor investing, risk premia investing, offers really kind of like a wide variety of approaches how you can implement that into the portfolio context.
Thank you. So in general, when you look at how exactly is factor-based investment defined, you always or very often find, the enlistment of different characteristics that are emphasized more or less. For example, momentum, value, volatility, and so on and so forth. It's then still to you to decide what characteristics you are emphasizing and to what extent and how exactly you are emphasizing on, or is it at some point also the customers who wish for a specific strategy? Martin, maybe you can add some here as well.
Yeah. Well, let me go maybe one step back and address another very important benefit of factor investing, and that's also risk management. And the beauty of the strategy is, on one hand, the investment case. So at Swiss Rock, we really truly believe factor investing is the basis of every investment process, not only on the alpha generation side, but also on the risk management side, because, I don't know, all risk models are somewhat factor models. And so that implies already that these both are combined, and that makes them so interesting strategies because you get an optimized return versus risk. And that's on a very reliable basis. And yes, there are a lot of different factor strategies. Value growth is probably the most prominent strategies that we all know. And as Christian pointed out, these are, why do they work? Because it's a risk premium you are earning as an investor. That means risk is involved in the world, that they are fluctuating. And here comes probably our knowledge into play when advising clients on how to aggregate these different risk premiums under consideration of the risk model to build a robust portfolio. And factor-based investing, at least to my understanding, is the only approach that has 30 plus years of history, lots of academic research, and that's really a reliable source for returns. And the different strategies typically, you use in your portfolio to avoid these drawdowns of risk premiums, which can be quite lasting. For instance, growth had a very good run over the last 15 years, and vice versa, value underperformed. And in order to compensate for that, we recommend a mixture of all these different styles in order to get the individual risk premiums, which are very hard to predict when which risk premium will be available to collect.
I mean, we would echo that actually as well. We are multi-factor investors, perhaps less on the risk premium side and more focusing on alpha. We look at how we can further enhance the value strategy from behavioral biases and things like that. But we very much focus on the fact that we are multi-factor. We do dynamically rotate between factors, something that most systematic managers struggle to do. We've been doing this since 2009. And one of the key points to make here is that if you are looking at a single factor in a myopic lens, you might have great exposure to the factor in focus, let's say value. You might buy a lot of cheap stocks, but then you might also have terrible momentum, terrible growth, things like that. So how you actually pull these strategies or anomalies together is really quite important. And we think that the IP involved in pulling that together really differentiates between providers. And it's why you see very kind of heterogeneous returns across different managers.
I think, yeah, just to build on what James said and also to emphasize what Martin said, I think the important point to know here is that factor investing is really built on a lot of academic research that was done in the past, right? So going back to the 80s or maybe even before, it was actually a great time for active portfolio managers because this factor investing was not really known. Portfolio return was consisting of alpha and beta, and everything that was not beta return was the alpha. So the portfolio manager could actually say, look at me, how great I manage this portfolio. I deliver you this amount of alpha. And then unfortunately, like in the 90s, this academic research by, Pharma French came out, and they actually were showing that a lot of these returns that have been previously partly beta or have been labeled as alpha can actually be traced back to this factor exposures that you had. And this is how this factor return and factor investing basically gained momentum. And just to give you, like one small little example, if I may, one of the findings that were back then done on the academic side was that, if you look at the CAPM model, so capital asset pricing model, which basically tells you that an investor should get like a certain amount of return for a certain amount of risk that he's willing to take, right? But then this academic research actually showed that in reality, there are, for example, like low-risk equities that in history, ex post, have actually given you a lot of greater return that the CAPM was actually promising or like forecasting. And this factor return, the so-called low-risk anomaly premium, is, for example, one of the factors that you can actually then try to exploit when you know this academic research that has been done.
Thank you. I think we're already in the middle of the whole discussion, but maybe to have some prominent aspect carved out again, maybe Martin, you can shed some light on what are, in your point of view, in your experience and opinion, actual advantages that you can really present right now of such investment strategies. Are there opportunities and risks that you have identified that you can say, well, they are always present, but we can mitigate them to some extent at least?
Well, first again, it's a reliable strategy. It is well researched, and the strategy over the last 30 years, all the individual factor strategies we touched here, value, growth, on an individual basis, even on an individual basis, they return around 2%. Additional performance compared to a benchmark on average. Again, on average, why? Because we have these cycles in between. So, if you have a multi-factor model and a well-balanced portfolio that addresses the different strategies which are maybe very risky. Let's think about momentum. I mean, momentum strategies as a standalone to my knowledge, do not really exist because it's so risky at turnaround points that you lose within a short period of time whatever you have accumulated over years. But in combination with the other strategies, value, growth, they build a portfolio that is very reliable and gives you an additional low risk, relative risk return over time. And the beauty here is it does not depend or just a little bit depend on the business cycles, on the market. So you find all over the world, you find these risk premiums. And if you are willing to invest in such a diversified strategy, you will earn these premiums. And that's the beauty of this factor investing. And it does not depend on persons. I have to say, it is a strategy that can be programmed, that can be modeled, and thus is not dependent on persons, on individual stocks, is not dependent that Meta yesterday announced very bad outlook for the future. No, it is reliable, and that's the beauty for investors.
We're talking about long-term here, though, right? There's always a long-term perspective.
Of course, there is a long-term perspective, and I mean, we have to be clear here. Factor investing had bad times as well. For instance, since the COVID crisis, the Magnificent Seven, the concentration of markets, that is a little bit something that is not working in favor of these strategies because they rely, as James in the beginning pointed out, they are not relying on individual stocks. They are relying on characteristics of a bunch of stocks. And when you have just 7 stocks that drive the market, then that's maybe not the very beneficial environment for this type of strategy. But looking ahead, we believe that this is going to change.
And I think exactly to that point, what you highlight there that's super important with all of this is innovation. If you take the French factors that were published in 1992, over time people become familiar, they know them, and as such we know that they don't work as well as they perhaps used to. Momentum, a good example of something that you highlighted. Momentum is known to have momentum crashes, published paper that we're all very familiar with. So thinking about how you then design your factor with this in mind, being able to mitigate these, whether it's dynamic timing, whether it's better cross-sectional selection. And we have progressed materially. We now process about 45 million data points every single day. We're looking at textual analysis, we're looking at fund flow data, finding new factors, innovative factors that we put into the multi-asset or multi-factor criteria such that we can ensure performance will maintain and continue to be good through time. That is obviously a lot of research and development, a huge amount of data cost. We have a range of academics that we work with. We employ them as consultants, but ultimately it's what needs to be done to make sure that we can generate enhanced returns rather than just risk premium, ultimately.
Right. And if I maybe just can add one point, I think we're talking about benefits and possible disadvantages or risks of factor investments, and I think we all 4 here agree. So we are also very much advocates for so-called like multi-factor strategies or a multi-strategy approach. And obviously, one of the risks could be that if you're just focusing on 1 or 2 single factors alone, that can obviously also lead to larger drawdowns because nobody can have a view with regards to the future, which kind of factor will outperform the market going forward. And we have seen over the last year this extreme performance dispersion between value and growth, for example. But one of the main advantages that I see for this factor-based risk premium approach, particularly when you focus on a multi-factor investment approach, is that you can actually pick and choose the factors that you want to have exposure to. So for example, when you just plain vanilla invest in the equity market, you get access to all sorts of factors in the market, right? So the market beta, size factor, everything else, what you then buy into your portfolio. But with, kind of like long, short approaches that you can do, you are actually able to pick and choose these factors or risk premia that you want to have exposure to in your portfolio, and then to combine them in an overall multi-factor approach so that risk can actually properly be handled. And I think that is a very big advantage of factor investing.
Maybe adding to that, what I've also read is the term of data mining, so that there's a certain risk that you only, emphasized one factors or just those parts of that factor that actually show good results, and there's a risk that you don't have the whole picture. How do you avoid that danger actually results itself? So to avoid that you don't have the whole picture for one factor when you choose a multi-factor strategy, for example.
I mean, from our perspective, we have a very substantial research process. Right. We try to make sure that a factor that's working in one region kind of works out of sample across regions, across different sectors, different countries. Generally speaking, when we're doing research on factors, it will take 1 to 2 years before we actually go from initial idea to actually production out of sample. And look, we also find a number of ways to try and validate the economic hypothesis that we're looking at. So we'll start off with an economic hypothesis, we'll come up with ways of capturing that, we'll then look at non-return based approaches to validating that. So a great example is value, right? We all know 18 and 19, value really struggled, value was dead. By the way, there's loads of academic papers saying that in 1999-2000 as well, when there was a US tech bubble. We did a huge project looking at, do we still really believe in not just the risk premium, but also the behavioral bias behind that? People typically extrapolate too far into the future, and therefore they think that companies that have performed badly in the recent past will continue to perform badly and too harshly treat those companies. So one thing that we did in that case is we said, well, looking at the companies, have they beat their expectations or have they missed their expectations? And rather amazingly, even when value was performing really, really poorly in 18 and 19, cheap companies beat their expectations and expensive companies on average missed their expectations. Now, absolutely admittedly, those cheap companies had expectations of 5% growth and they actually hit more like 7% growth. Expensive companies had expectations of 40% growth, and they actually hit 35% growth. But the point is that 40% growth should have been in the price, and they actually hit 35. And at that point in time, people were saying, oh, well, they'll just get it next quarter, they'll get it next quarter. But as we know, that wasn't the case. In 2021, value performed exceptionally well. So that's a good example of how we try to validate our research using other means rather than just returns.
Speaking of validation and research, I think that's one of the aspects I also would like to have your opinion on. Factor-based investment is always, very often to be presented, it's an alternative to an active managed strategy or a fund. So that to some extent would also presumably mean there are lower costs for the whole management. But the research aspect is probably where the whole work is invested in, right? So how exactly is the cost based for factor-based investment strategy?
I would guess we differ here. I'll very quickly. So we have a market neutral funds that we charge 75 and 20. We see it as active, 5% risk, 5% return, IRs of 1, 15-year track record. We very much see it as an active proposition. The long onlys have similar track records. Active proposition, active fees. I would imagine you guys see it a little bit differently, maybe.
Well, no, we see it as an active approach as well, optimizing risk-return ratios, information ratio. That's the ultimate goal, because it's then up to the investor to decide how much risk he's ready to take. And I mean, research is very important as well. And as James mentioned, implementing new factors is always quite a long process. You have to do a lot of testing, and for us it's also important that the factor makes economic sense, that what we are looking at, we should understand what is the mechanism. Does it make sense that this company's or performance is behaving in a way that we cannot explain economically? And then the other thing is maybe when building models, you should try to keep them as simple as possible, because obviously with a lot of backtesting data you can come up with the perfect strategy, twisting, tilting, And we really try to avoid that and keep it very basic and look at correlations and really try to build a model based out of as less factors as possible, because additional factors, they just add maybe noise and they do not add a new aspect to and bring them to the model. So when you look at models and you add on factors and factors, first your performance is increasing, and at a certain point you're not adding any more, which then shows you there is no additional information in the factors. And yes, such a process takes long. And coming back to the risk premia, investing with factor models is not for free. There are some risks as well, and you have to sustain certain drawdowns even if you have multi-factor models. That's part why you earn the risk premia. And if you're not ready to accept that, sorry.
Martin, you mentioned in the talks we had beforehand that the factor-based investment wasn't always as popular. I mean, you mentioned there was a drawdown to some extent in the last couple of years, particularly when we look at the US. Maybe from your experience, how exactly, what was the reason for that, and how did factor-based investment re-establish itself? Obviously for you, you didn't change anything at all, so you just went through that period as well. How did you experience that, and what effect did it have to what extent?
I mean, the US market is always a very difficult market. I mean, it's a very efficient market. And the concentration in these large caps that we have seen over the last 5-7 years, that hasn't been beneficial to factor models. Why? A factor model typically invests in a lot of stocks to mitigate the stock-specific risks, and therefore is relying on the fact that a group of stocks with certain characteristics described by these factors can outperform the market. What we observed in the last years is that it was a very, very limited group of 5, 7, whatever, stocks that outperformed the market, and the rest didn't perform on a relative basis better than the market. So in such an environment, it's very difficult to outperform the US market. Luckily, other markets, European markets, emerging markets had a completely different setup. For instance, emerging markets, the twist was the other way around. Large cap underperformed there. We had a lot of small caps outperforming, and there you could make up for the underperformance in the US by outperforming, for instance, in the emerging market. And that shows the beauty of this global approach. You maybe lose at one part of the market, but you can gain on the other, on other regions, other sectors. And so in that sense, the US market is unfortunately the biggest market. In that sense, it hurts when you're not outperforming there, but you can reduce the relative losses by other regions.
Coming to the last topic for this group, and if you do have any questions, I think we will find some time at the very end. In this very room, in the course of this day, there were so many panels with a focus on ESG topics. ESG obviously also affects your work, I would imagine. So to what extent can you implement ESG strategies into factor-based investment? Is it something that you were actually looking after, or is it something that runs completely outside of your strategies so far? I start again with you, Martin, but obviously I think all of you have an opinion on that topic.
Well, thank you. There are two ways to look at it. From a factor perspective, ESG is the best thing that can happen to you as an active manager. ESG is another factor. So we are used to deal with that. We can look at the history.
Yeah.
Does it help? What are the tilts that we bring into the portfolio? Are they wanted or not? We can control for this aspect. And there is another interesting aspect here that we deal a lot with pension funds, and they come to us. They have a clear idea how they want to implement ESG. So they have an idea. We want to exclude this type of stock. We do want this kind of ratings. We want this data provider that you are using in building the strategy. And the more exclusions you have, the more the portfolio is tilted in a certain way. I mean, we have all seen that ESG prefers on a sector level technology, it prefers large companies, it prefers high quality companies. So that worked perfect over the last 5, 7, 8 years, which is maybe also a little bit the source of the success of all these ESG strategies. But you as an active as a manager, you can help your client to show them where the risks are, that they are overweight technology because of ESG, that they are underweight certain aspects in the portfolio. And here, factor investing can help to bring back the portfolio to mitigate unwanted factor tilts. In that sense, we are very happy, and we believe that factor investing is really the best approach to cope with ESG and implement that on a very, very natural way in a strategy.
I would agree with some of that, not all of it. The bits that I do agree with is that ESG is definitely a factor, or 3 factors as we see it. Being factor investors, this is bread and butter for us as we see it. We have to also be honest about the quality of the data that comes in from ESG. We use 4 different data providers. They don't agree with each other. And exactly to some of the biases that were being discussed, instead of accepting those biases, we control for them. So if you're a larger company, you typically have a better ESG score. Is that because they're better at ES&G, or is that simply because they have better corporate disclosure and larger teams? So we adjust for that. If you're a big company, you have to be even better. If you're a small company, then we give you a little bit of grace. We also do focus very much on generating alpha from ESG, or from ESG disclosures. We started looking at ESG data back in 2014. We did not implement at that time because the data quality was so poor. Data quality has increased quite a lot. Ultimately, if companies are telling us more about what they're doing, we should be able to learn more, get a better view of the company, and ultimately generate more alpha from that. So that is something that we have been focusing on an awful lot. That doesn't just mean you invest in the best ESG companies. Every now and again, you find strategies which means that horrible ESG things actually do quite well. We don't invest in those. But really focusing on where we get the most alpha is the change, going from good to great, also going from terrible to bad, ultimately. But all of our funds that are Irish domiciled are SFDR Article 8. The Equity Market Neutral Fund is SFDR Article 8 and one of the few market neutral funds in the world to do so. It is difficult when you talk to the regulator about short selling, explaining that shorting a stock is actually better than not holding it, for example, is a long conversation to have. But ultimately, it's an important conversation to have because we need to kind of be clear on what we're doing. And we don't market ourselves as ESG friendly, but instead we just communicate that we're generating alpha, generating returns in a way that we can keep doing for a very long time. And that's ultimately what our clients care about.
So, since you also and already mentioned it, the data wasn't always very good, wasn't always very profound. It's probably an issue you're still having, albeit there are certain guidances with regards to ESG standards. Is there a certain risk, Christian, when we're talking about ESG, and we have the term of greenwashing? If you have to take those aspects into a factor-based strategy, that at some point we're talking about factor basing and false labeling of a strategy because you're taking over certain negative aspects. I quickly go to Chris.
Oh, sorry, yes, sorry.
I think the beauty of factor investing is actually that you have many different ways with regards to how you can integrate ESG, right? And let me give you like 2 examples. So the first example is that when you're working with risk premium or factors, you also need to make sure that you have a robust set of metrics behind each of the factors with regards to how do you define the factor, right? So what is quality? What is value?
Right.
And so, for example, if we're talking about quality companies, what we have done since a couple of years, we have integrated like the ESG score into one of our metrics of how we define quality, because history has shown that typically speaking, companies with a higher ESG rating also display higher quality overall. So that is the first example of how you can integrate that into factor investing. And the second example is, for example, that this is mainly referring to our kind of like smart beta enhanced indexing approaches, is that when you want to integrate ESG there, you can actually move from kind of like exclusion type of solution into best-in-class solution. So what you can do is that starting from that investment universe that you're looking at, you can actually already apply a huge ESG overlay with regards to certain exclusions based on sectors, based on emissions, based on UN principles. You can already have this overlay in the beginning of the process in order to reduce that investment universe down to the number of companies where you believe it's a robust set of kind of like ESG companies. And then later on, when you are optimizing the portfolio, you can integrate like additional kind of like restrictions to the portfolio. You can say, I want to have like a portfolio with a certain level of carbon emission reduction. You can say, I want to have a certain portfolio with a certain level of minimum ESG score that you want to have. So let's say on a company level, you want, for example, like a minimum ESG rating of BB, while for the overall portfolio, you make sure that the minimum level of ESG is at A, for example. So there are like many different ways with regards to how you can implement that ESG approach into factor investing, and with regards to factor washing or greenwashing, how you have expressed it, Simon. I think in general, factor investing has gained a lot of acceptance and popularity over the past years. I think that can be said for sure. And I think the general, not problem, but the general kind of like issue is that factor investing and how you build a portfolio needs typically more explanation than typical top-down asset allocation approaches. So typical plain vanilla top-down asset allocation approaches, pretty much everybody understands. But when you drill down into the kind of like, factor-based or risk premium-based investment approach, this automatically requires a higher level of explanation. And this obviously then also is true if you are including ESG overlays on top. So in the end, you have to make sure that the client, be it like an institutional client, be it a retail or wholesale client, that the client really understands how the portfolio is constructed, that he understands what you are doing, and that he's not just buying for performance without understanding what the portfolio is doing. So I would kind of like separate that greenwashing, factor washing thing to a more general approach, saying factor investing needs naturally more explanation than traditional top-down approaches.
Right. With looking at the watch, and we're actually getting closer to the end, are there any questions from the audience that you would like to ask? Yes. Is it on already?
A simple question, actually. How you deal with the stability of the factor models that you're using, and how do you use your factor approaches in the optimization of the portfolios?
So from our perspective, we have models that forecast future return, models that forecast risk. They then go into an optimizer, and the optimizer resolves for the best positions, the best trades to do for that particular day. We trade every single day. Stability of the optimization is something that we explicitly have models for to control. We do things in the risk model which smooth the estimation of risk. We do things in our forecast of future return to standardize versus others. And it is part and parcel of the approach ultimately.
But if you look at the time series, you have a lot of structural breaks. How you tackle those?
Yeah, so one of the things that we do, being dynamic investors, and I will pass on, I apologize, I'm speaking so much. Essentially, we look at the current market environment today, and we go back through time to identify historical periods of similarity. For example, volatility, when crisis hits, whether it be COVID, Lehman Brothers, whatever, in a crisis, volatility spikes. We will therefore say, well, volatility is high now. How did our factors perform in other periods of time, other regimes when volatility was high? And we take that as an education for our inputs, ultimately.
We try to tackle these problems, structural breaks and things like that, by diversification across the factor strategies. That means that for, let's say, value had a longer period of underperformance, it is still part of our model. That's subtracting certain value, but on the other hand, as you might remember, November 2020, when a vaccine was found and then value within a few days outperformed, then this helps to overcome these kind of structural breaks. So having a combination of the different strategies gives you a very well-diversified portfolio and helps mitigate negative or adverse performance in such structural breaks. That's how we do it.
I think that's in fact like a very, very good question. Yeah? And you know, the way we try to, kind of like optimize the models is that obviously we are in the process of, constantly kind of like refining our model output, right? Because we have different market phases, certain types of anomalies in the market that you also need to factor in. And one, kind of like approach of how we are trying to increase the stability of the model output is that we would always also have kind of like a fundamental oversight at the end of the process. So what that means is that we would, as portfolio managers, not typically rely blindly on the model output and implement whatever the model output is, but there would always be at the end of the process, before the implementation starts, there would always be kind of like a fundamental oversight to really see if the model output makes sense in an overall economic view. And I think that is very important, because otherwise, if you're blindly relying on the mathematics, blindly relying on model output, you always run the risk that the model has not captured certain aspects of the market that you can only see as a kind of like a discretionary or more fundamental, from a fundamental perspective. So taking models, taking quant models, as kind of like signaling is always good, but for us it always needs to be in combination with a fundamental oversight.
Thank you very much. Very interesting so far. My question is, if you decompose the market into all the factors, because you say they're the building block of return, and then you said each factor in itself outperforms the market by 2%. How does that work? Because you decompose it first and then you compose it back together if you take all factors. I don't understand how that should work. And the other question, maybe that follows that, is the Holy Grail, would that not be to exactly identify which factor is the right one to be in now, and why doesn't that work? Because, I don't know, do the factors, they don't have a momentum, or don't we see that value will underperform and it hasn't performed for 10 years, but now it will? So maybe those two questions.
Maybe, thank you. That's a very interesting, and probably we too have a different view there.
Exactly, happy to fight.
Regarding the performance of the single factor models, it's simply part of the market. When you build a strategy, let's say a value strategy, you just take a small chunk of the stocks in the market. So, and saying the risk premium for holding cheap stocks, some of them are cheap because of a reason, some argue it's because of higher volatility and so on. So you earn this risk premium for holding cheap stocks on average over a longer period of time. And then there is another strategy that, for instance, quality, saying again, stocks with a high quality balance sheet on average perform better. And that's the meaning of these different factor strategies, that each of these characteristics provides you a risk premium, on average a positive one. And for the combination or the prediction of these factor rotations, again, risk premia, we have different time scales where these rotations happen. I mentioned before, value performed last time very nicely in 2006 and then underperformed up to 2020. So there are very long period of time when one style can underperform. And so predicting these cycles, which are so diverse, is quite a bit of a challenge. That's why we suggest the foundation should be a diversified portfolio, because you cannot forecast what's happening next, but maybe then on top you can do some tilts. And the question then is, what is the driving mechanism that triggers that value starts outperforming? And I guess specifically the last 5 years have been very surprising, because typically you say during crisis value should be the better strategy. However, in COVID crisis it turned out to be the other way around, because of home office, all these large cap growth companies in the US did hold up far better than anything else. And so I'm interested to hear how you manage that.
Yeah, certainly. So, I mean, to your second point in particular on timing factors, I would absolutely agree with what you're saying. But we also have to be very pragmatic on how much ability we have to time these factors. And there's a lot of literature in academia, a lot of literature from practitioners who have tried and failed, frankly speaking. We have successfully been timing factors since 2009, but that is no easy feat. Just like if you were to time sectors, for example, if you get it right, then you get large rewards. If you get it wrong, then you don't get large rewards and you actually get hurt. So how we go about timing factors, a little bit like you were saying, we do have a diversified portfolio of factors, and then we tilt between those factors, making sure that the size of the position that we're taking in the factor, the size of the overweight, is proportional to our conviction in whether we're going to be right or wrong ultimately. But as I'm sure you're very well aware, I mean, if we know what was going to happen tomorrow, then we'd only have to hold one stock. But we don't. We have to forecast that. And ultimately, time series prediction is hard. It takes a lot of IP. We have academics in computer science and statistics looking at specific statistical techniques which are beyond the literature, simply to evaluate our timing mechanisms. We don't have that much data in the time series. So it is a significant undertaking, but it's something that we've been doing for 15 years and we're very comfortable with. But I would absolutely agree with you. And even if you take a step back and you say, even if you don't think you can generate alpha from timing factors, we know, and as has been heard, factors do underperform at periods of time. And even just from a good principles of risk management, reducing risk when things are going badly makes sense to us. And that is essentially a form of timing. So I would very much advocate and agree with what you're saying. We're also evidence-based investors, and we look at how much conviction we have in our ability to do it, and we position sizes accordingly.
Perfect. With looking at the watch, I have to finish right now. If you do have additional questions, please don't hesitate to reach out to us. With the exception of Christian, I think all of us do have a couple of minutes if you do have additional questions. If not, and in any case, I would like to thank all three of you for your participation and for you for being here and listening to us very actively. Wishing you all a great afternoon. Thank you very much.
Thank you.